You are on a financial journey. It is not a one-hit wonder like a tax return. It's not a snapshot in time. It truly is a financial journey. It's a journey at the Financial Enhancement Group that we like to help people go through. But you're going to go through 3 distinct phases of finance on that journey. There's going to be a period of time where you start to accumulate money. There's certain things you should do then, and we're going to share with you on Consider This program what they are. Eventually, there's going to get to a point in time where you're in what we call preservation. You've saved up a sizable chunk of money. And then eventually, you're going to distribute those assets. Now, some of you are going, Joe, no, have no real intentions of using my money. My friends, let me share with you. You will exit your retirement plan. Your money will exit. It can either be by your own decision. It can be by the decision of the IRS in the form of required minimum distributions. Or you can pass and leave it on to your heirs. But the money will exit the retirement plan. What we want to do is help you do it in the right order. The best way to do that is to help you understand the 3 phases of finance that you're going to go through and the goals and objectives that go with each one. Good morning and welcome to Consider This program. I'm your host, Joe Clark.
And I'm Aaron Rheaume.
We are happy to have you along. Hey, welcome. Aaron is our Director of Financial Planning. He is one of my partners. So happy to have him here. And we're going to talk about one of the observations that I came up with years ago. I'm sure I'm not the only one, that has ever reached this conclusion. It's just, I looked at life and, Aaron, I noticed that Wall Street really had a favorite place, right? Wall Street really doesn't care about broke people.
So, yeah.
Right? Wall Street really doesn't care about young people starting out.
Nope.
Now, the people who sell things, what I'm talking about when I say Wall Street are registered investment advisors, fiduciaries, people who sell life insurance and annuities. That can be different, right? But most of all, what Wall Street doesn't like is retirees who are distributing assets, right?
Sure.
They actually even refer to it as leakage, right? When you're spending your money and using it, your assets are going down. And they track, and I do too, truthfully, inside, the distribution rate. The problem is the higher the rate, the happier I get because it means people are using and enjoying their money, right? So there's an expression on Wall Street that I've said this on this radio, and I was, one of my people told me, Joe, you really need to explain this because it's powerful and nobody gets it, right? So every time a stock is bought and a stock is sold, that is called a trade, right? You have a willing buyer and you have a willing seller. By definition, ladies and gentlemen, somebody's wrong, right? The stock is either going to go higher and you're going, why did I sell, right? Or the stock's going to go lower and why didn't I sell more, right? That's the attitude that happens. Now, truthfully, there's a lot of reasons to buy and sell stocks, and it's not necessarily if somebody was right or wrong. But you have a willing buyer and a willing seller. They're on opposite sides of the trade, regardless of their rationale. What happens in planning is that, in my opinion, especially at your retirement years, you have 2 parties on the wrong side of the trade. See, as registered investment advisors, we manage more than $600 million at the time of this recording. As registered investment advisors, I get paid, our firm gets paid to manage assets. Right? That's what we're paid to take care of. We do the financial planning because we think it's important, and that's just something that we provide. We don't bill people for it. We don't charge for it. We teach you these kind of things and help with the tax planning because it's the right thing to do, right? But I get paid, my income, the money to the firm is based on the money that's in the account. So when you spend money, I get paid less. Wall Street gets paid less. I think that makes sense, right?
Sure.
So when people walk in, even the most confident of confident, right? You got $1.8 million in an account and you've done a great job, you've saved and accumulated, and you walk in, there is a little bit of angst, a little bit of fear, if not in both of you, in one of you, that has, what if we run out? What if we don't quite have enough, right? It does not take a lot for an educated broker or somebody that's a bad apple to help grow that fear. To say, now, Mrs. Shipley, you shouldn't spend quite that amount of money because what if you run out? Do you really want to be 90 years old and not have enough money to support yourself or stay in your house? right? There's all these things that can be used to make sure that you do not run out of money. And suddenly what you have are two people both on the wrong side of the trade. Suddenly you've got people who are not using their money. They saved and accumulated so they would have a better retirement, and they're not using the money, and it's because you've got both people on the wrong side of the trade. Part of the uniqueness of the Financial Enhancement Group is we take you over here. We put you on the right side of the trade. We are going to encourage you to spend money, teach you how to do the distribution in the correct way, and we want to help you build the goals and objectives that you need in each of those three phases of finance so that you can have your life after work, or what some people call the retirement, that you deserve. So, Aaron, tell me about accumulation. The phase of finance number one, accumulation.
First phase of finance, accumulation. The most important things to do there's two of them, is to make sure that you're saving the right percentage of money and building tax diversification.
So how do I know it's the right percentage?
That is completely up to the individual. If you're working with someone that's going to put together charts and graphs, we can get you to a good number. But whatever's comfortable at the first part, and then we can work into making sure you're hitting your goals.
So somebody who doesn't work with charts and graphs, my answer is always the younger you are, the less you have to save.
Yes.
The older you are, the more you need to save. Right? Compound interest, Einstein, eighth wonder of the world, right?
Yep.
It is all true. But do not focus on the returns. In here, you're focusing on the tax diversification, tax-deferred money, tax-free money, and money that's after tax. You don't know what the IRS is going to do you in the future, and you want to be able to choose and pick where you take the income that you want. And then the second, of course, is saving that right percentage of income, which Aaron and his team can help you figure out what that percentage should be. So what happens after accumulation?
Then you move to preservation.
Okay.
Preservation is the only time average return matters.
Why is that?
Because you have to be there beginning, middle, and end, and you can elaborate on that.
So you're not using your money. So Wall Street, when you mention the word preservation, and this really is an FEG term, you won't find it there. You'll still hear people call it accumulation because they don't want to fess up to what it is. Preservation, the way I define it, is when you may still be saving money.
Yes.
But what you're saving doesn't matter near as much as the baby that you've already built, right? And what happens with an average return, as long as you're there beginning, middle, and end, it doesn't matter how much volatility there was over an extended period of time, markets have always gone higher. Now, that doesn't mean they always will. There is no guarantee, right? But where we are today and what we know historically is markets over a period of time work their way up.
Yep.
As long as you were there in the beginning, there in the middle, and there in the end, you can talk about average returns all day long, and they're realistic numbers. But you've got to have the discipline. Think emotional trading we talked about a couple weeks ago. You have to have the discipline to be able to say, hey, I'm in this game. I'm ready, right? I'm prepared. I'm going to deal with the March of 2020. I'm going to deal with the recession of 08 and 09. I'm going to deal with the tech wreck of 2000. I'm going to deal with 2002. 2002 was one of the worst years in the history that nobody talks about. I'm going to deal with all of this stuff. The crash in 87, I started 2 weeks after that. Count me lucky, right? And when you say preservation, you can just pretty much hear Wall Street go, ta-ta, right?
Yep.
The charms, because that's how they get paid. Right? The money's sitting in an account. A broker calls you a couple times a year, maybe takes you golfing or out to dinner when it's not COVID-driven periods, right? And, not a lot changes. Wall Street gets paid. Everybody is happy. And as long as the market goes up, you think you're getting everything that you deserve. Go back to that conversation I had about character trust. You're counting on the guy, the friend, the relationship without understanding the competency trust, what it is they really ought to be doing for you to earn their keep, right? So Wall Street loves this. Now, Wall Street hates the next chapter. They hate what I've spent my entire career working on, which is what we call the distribution phase. So tell me what that is, Aaron.
Distribution is landing the plane. It is, going up from accumulation to that 30,000-foot overview of the flight and landing the plane. And really, Joe, the two focus points there are making sure we're managing volatility between distribution points, so between the time that you need to have money distributed to your accounts and the average tax dollar that you're paying on those distributions, because those matter just as much as managing towards that volatility.
Those two things matter critically. When you look at our tax system and those stair steps, after you have your standard or itemized deduction, You're going to be in the 10% bracket. You're going to jump to the 12% bracket. And then you're going to go, ta-da, up to 22% is the next step. What we want to do is try to help you at retirement time, not necessarily while you're working. Make as much money as you get paid, right? But what we want to do is try to help people stay inside of that 12% bracket, maximize it. You can live in Central Indiana with a good planner. You can live in Central Indiana with $106,000 a year of taxable income and stay in the 12% bracket as of 2021. And to not do that is just a shame. We can talk about rates of returns and all that. That's what we get paid to do. We focus on it. I've got a CFA, a chartered market technician, myself, we run the portfolios in terms of how we look at that big picture of those markets. We've got, 7 people or 8 people on our planning team that are able to sit down with you to make all of this come true. That understanding and that distribution that your money is going to exit retirement accounts, right? When you started saving and accumulation to have a better retirement, you did the heavy lifting. You said no to Disney. You said no to bigger houses, nicer cars. You said no to things that you might have wanted to do. You were disciplined and focused, and now you're at distribution, and you have a tendency to do one of two things. Say, hey, I can't hurt. I've worked too hard to have $1 million. I worked too hard to have $1.8 million. I worked too hard to hurt that statement and take money out. For 40 years, I've accumulated money, and now you want me to distribute. It's just not natural. The second thing is people just don't need the money. Right? The people who lived with margin, who could save, don't necessarily need the money. My job, Aaron's job, our job at the Financial Enhancement Group is to help you understand that that money is going to exit. It can either exit by your choice in the most tax-efficient manner possible, or it can exit by the IRS's choice with required minimum distributions at the worst tax efficiency possible, or you can pass away with it and leave it off to your heirs who have to deal with their own tax nightmare. Many times, it's worse than what you would have done if you would have recognized the taxes. So accumulation, two goals and objectives. What are they, Aaron?
Saving the right percentage of money and building tax diversification.
Bingo. And then the money grows. Eventually you have more than what you're adding to, so you're taking care of the nest egg and the baby. That's what we call preservation. This is the only time that average return matters. And then we go into distribution, where we begin to build that retirement that you've worked so hard for, that you worried about for so long. And we do it so you don't have a fear of running out of money. We do it without products and commissionable stuff. We do it as fiduciaries, where we treat your money as if it were our money and we were in the same situation. And we do it with a team of 29 people who have expertise in various areas, who've done this for a long team, all working together, collaborating with your CPA, or at least providing you the tax guidance if you do your own return. In distribution, Aaron, the 2 objectives?
Managing volatility between your distribution points and the average tax dollars you're paying on those distributions.
Bingo. And if everybody in the room can't answer the question the same way, then you're dealing with the wrong people. There will be a period of time when I'm not here, a period of time when Aaron's not here. Right? This can't be about a relationship with a person. It's got to be a financial journey with a company that has the right process. YourLifeAfterWork.com, 800-928-4001.